I am getting you out of debt. I am getting you out of debt. You are out of debt.
Hey there, I'm Lisa, your no BS guide to smashing debt and owning your financial future. Whether it's wiping out that mortgage, killing credit card balances, or stacking real wealth, this is your episode. Today's topic is 5 critical interest concepts everyone should learn before borrowing, and why focusing on an emergency fund first is exactly the right move. Let's dive in and make it happen. Please grab pen and paper. You will need to take some notes. Let's treat this like building a foundation for all your future money decisions. I'll explain interest rates and terms in plain language, give clear examples, and then walk through what you should do in common real-life scenarios: saving, borrowing, credit cards, etc. 1. What is an interest rate? Interest rate equals the price of money. When you borrow, it's the cost you pay to use someone else's money. When you save or invest, it's the reward you earn for letting someone else use your money. It's always expressed as a percentage per year, annual rate, even if payments happen monthly. Example, borrowing. You borrow $1,000 at 10% per year simple interest. After 1 year, you owe $1,000 principal plus $100 interest equals $1,100. Example, saving. You save $1,000 at 4% per year. After 1 year, you have $1,000 plus $40 interest equals $1,040. 2. Simple versus compound interest. Simple interest. You pay or earn interest only on the original amount, principal. Formula. Interest equals principal times rate times time. Example, simple interest saving. $1,000 at 5% simple interest for 3 years. Interest equals 1,000 times 0.05 times 3 equals $150. Total equals $1,150. Compound interest. You pay or earn interest on the original amount plus the interest that has already been added. This is what most real-world financial products use: loans, credit cards, savings. Example, compound interest saving annually. $1,000 at 5% compounded yearly. End of year 1, $1,000 times 1.05 equals $1,050. End of year 2, $1,050 times 1.05 equals $1,102.50. End of year 3, $1,102.50 times 1.05, approximal $1,157.63. You earn more than the $150 from simple interest because interest builds on interest. Key idea. As a borrower, compounding works against you. As a saver or investor, compounding works for you. 3. Fixed versus variable interest rates. Fixed rate. The rate stays the same for the life of the loan or account. Predictable payments, easier budgeting. Example, 30-year fixed mortgage at 6%. Your rate and base payment won't change. Taxes, insurance can, but the interest rate doesn't. Variable or adjustable rate. The rate moves up or down based on some benchmark, like the Fed funds rate or prime rate. Can start lower than fixed, but you take the risk it rises later. Example, a credit card may say prime plus 15%. If prime is 8%, your rate is 23%. If prime rises to 9%, your rate becomes 24%. Best practice. For long-term big loans like a house, most people are safer with fixed rates. Variable can work if the loan is short-term and You can handle payments if rates rise. 4. APR versus interest rate. Interest rate, the base percentage charged for borrowing or paid for saving, does not include extra fees. APR, annual percentage rate, the true yearly cost of a loan, includes interest plus many fees, origination, some closing costs, etc. Helps you compare loans more fairly. Example, Loan A, interest rate 7%. With fees, the APR is 7.8%. Loan B, interest rate 7.3%. Higher fees, so APR is 8.5%. Best choice? Even though Loan B has a slightly lower rate, 7.3%, Loan A is actually cheaper overall because it has a lower APR, 7.8% versus 8.5%. For credit cards, the APR is the main number to watch. It tells you how expensive carrying a balance is. 5. What determines your interest rate? Several pieces get added together to form the rate you see. 1. Real interest rate. The lender's base profit for lending money instead of doing something else with it. Historically, often around 4% over long periods, but it changes with markets. 2. Inflation expectations. If prices are rising at, say, 3 to 5% per year, lenders charge extra so that the money they get back has similar purchasing power. 3. Risk premium. Risk of not being repaid. Higher risk of default equals higher rate. If a lender thinks there's a 5% chance they won't be repaid, they may add around 5% to the rate as a risk premium. Simple example from the research you saw. If real rate equals 4%, inflation equals 5%, risk premium equals 2%, total interest rate approximately 4% plus 5% plus 2% equals 11%. If risk jumps to 8%, riskier borrower, 4% plus 5% plus 8% equals 17%. What affects your personal rate? Your credit score and history, your debt-to-income ratio, your collateral, car, house, etc. Overall economy and central bank policy, Fed funds rate, prime rate, etc. 6. Key loan terms to understand. When you see a loan or credit agreement, here are the big terms. 1. Principal, the amount you borrow or invest. 2. Term, how long you have to repay. For example, 5 years, 30 years. 3. Payment frequency, monthly, biweekly, etc. 4. Amortization, how payments are split between interest and principal over time. 5. Fees and penalties, origination fees, closing costs, prepayment penalties, late fees. How term affects your payments and total cost. Longer term equals smaller monthly payment, but more interest over time. Shorter term equals higher payment, but less interest overall. Example, $10,000 loan at 8% fixed. 3-year term. Monthly payment approximately $313. Total paid approximately $11,268. Interest approximately $1,268. 7-year term. Monthly payment approximately $156. Total paid approximately $13,104. Interest approximately $3,104. Same loan, same rate, but the longer term costs you nearly $1,800 more in interest. 7. Interest on savings, APY versus rate. For savings accounts and CDs, interest rate, base rate. APY, annual percentage yield, the real yearly return including compounding. Example, Bank A, 4.5% interest, compounded monthly. APY may be approximately 4.6%. Bank B, 4.5% interest, compounded daily. APY slightly higher. When comparing savings accounts, APY is the better number to use. 8. Real-world examples. How this hits your wallet. A. Credit card balance, high interest, compounding. You have a credit card with 24% APR, $2,000 balance. You pay only the minimum each month, say 2 to 3% of the balance. Outcome: you'll pay hundreds, even thousands in interest over time. The high rate plus compounding keeps you in debt for years. Better scenario: pay more than the minimum, ideally pay in full timeline, or transfer to a lower rate card if you can pay it off during promo period and avoid new debt.
Hi, I'm Sarah. Overwhelmed by debt? There's a proven way out. Debt-free, made easy, transforms debt into money back in your pocket. Eliminate all debt fast, without refinancing or consolidation. Proven results since 2004, over $2.8 billion eliminated. Thousands have eliminated mortgages, credit cards, auto, student, and personal loans. No refi, no consolidation, just results. Our Debt Crushers AI software eliminates all debt. Fast, simple, 100% satisfaction guaranteed. I have eliminated $275,000 of my own debt. Scan or click on the link below to start putting your money back into your pocket. Eliminating debt since 2004.
B. Auto loan, medium interest, fixed. You finance a car, $15,000 at 7% APR, 60 months, 5 years. Monthly payment is moderate and the rate is fixed. This is a normal, manageable type of loan if the payment fits your budget. Extra payments early on save you interest. C. Savings for emergency fund. Interest works for you. You put $200 per month into a high-yield savings account. APY is a 4.5%. After 1 year, you've contributed $2,400 and earned some interest. Over a few years, compounding becomes meaningful. This is low risk, flexible, perfect for emergency funds. 9. Best scenario strategy. What should you do? Let's translate all this into clear actions and priorities. 1. For borrowing money, I recommend: avoid high-interest debt first. Credit cards and payday loans with APRs 20 to 30% plus are financial emergencies. Goal: pay them off as fast as reasonable before investing heavily. 2. Choose fixed rates for big or long debts. For a mortgage or big auto loan, favor fixed-rate loans. This protects you from rising rates and makes planning easier. 3. Shorter term if you can afford it. Choose the shortest term that still fits your budget comfortably. You'll pay less total interest. 4. Watch APR, not just the rate. When comparing loans or credit cards, use APR, includes fees. 5. Improve your risk factors to get better rates. Pay bills on time. Keep credit card utilization low, ideally 30% of limits. Reduce overall debt. And build a stable payment history. 2. For savings and investing. 1. Start with an emergency fund in high-yield savings. Target 3 to 6 months of essential expenses. Use an account with a high APY, no or low fees, and easy access. This is where you want to benefit from interest rates on savings. 2. Use compounding to your advantage. Automate monthly contributions. Don't withdraw unless you truly need to. 3. Match the vehicle to the time horizon. Short-term goals, more than 3 years, savings account or CDs, focus on safety. Long-term goals, 10+ years, consider diversified investments like broad index funds, where long-term growth can outweigh short-term rate changes. 3. General best practice mindset with interest and terms. Borrow as little as possible, as cheaply as possible, for as short as possible. Save as much as possible, as early as possible, at the highest safe yield available. Understand rate, the cost or return per year. Term, how long you're locked in. Compounding, how often interest is added. APR or APY, the real cost or return. 10. Applying this to you. You mentioned income, about $2,500 per month. You're starting with an emergency fund goal. Next smart steps related to interest and terms. 1. Open or confirm a high-yield savings account for your emergency fund. Look for no monthly fees, good APY, FDIC, NCUA insured. 2. Decide how much you can automate monthly into that account. For example, $200 to $300 per month. 3. If you have any high-interest debt, credit cards, etc., tell me the approximate rates and balances, no account numbers, and I can help you prioritize. How much to put toward the emergency fund versus how much to put toward paying down high-interest debt. You now understand what interest and terms actually mean, how they affect both your debt and savings, and you have a concrete plan to build an emergency fund and manage your $2,500 per month in a way that grows your safety and reduces stress over time, without cutting all the fun out of your life. Why focusing on an emergency fund first is exactly the right move. I will walk you through 4 steps and give you some default numbers you can adjust to your real numbers. 1. Decide your emergency fund target. An emergency fund usually covers 3 to 6 months of essential expenses, not fun stuff, just what keeps your life running. Since you're earning about $2,500 a month, let's estimate your essentials. Think about your monthly must-pay costs: rent or mortgage, utilities and internet, groceries, transportation, gas or public transit or insurance, minimum debt payments, phone, basic insurance. If you're not sure, a quick rule of thumb: essentials often fall between 60 and 70% of take-home pay. Using that, 60% of $2,500, approximately $1,500 a month essentials. We'll refine later. 3 months, $4,500. 6 months, $9,000. For now, I recommend Phase 1 goal, $1,500, 1 month. Phase 2 goal, $4,500, 3 months. We'll focus on Phase 1 first, so it feels achievable. 2. Pick a monthly savings amount. You mentioned not really tracking spending yet, so we'll start with a simple, reasonable default. Start with 10% of your income, $250 a month. If that feels too tight once we look at expenses, we can dial it down to $150 to $200 and build up. At $250 a month, to reach $1,500, about 6 months. To reach $4,500, about 18 months. This is a solid, realistic pace. 3. Set up a simple system so it works on autopilot. You don't need a complex budget right now, just a basic structure plus 1 habit. Open or designate a separate savings account. Use a separate high-yield savings account or at least a separate savings at your bank. Name it emergency fund so you see the purpose every time. Automate the transfer. Every payday, set an automatic transfer of $125 if you're paid twice a month, or $250 if paid once a month, from checking emergency fund. Treat it like a bill you owe your future self. Create a light spending awareness habit, no hardcore budgeting yet. For the next 30 days, write down or track in an app like Simplify, Rocket Money, or even phone notes, just rent, groceries, transport, other necessary bills. This will let us tighten the emergency fund target later with real numbers. 4. Find 2 to 3 easy ways to free up cash. To make saving $250 a month painless, I recommend you choose any 2 to 3 of these. 1. Subscriptions audit. Saves $20 to $60 a month. Cancel or pause anything you don't really use, streaming, apps, memberships. 2. Eating out cap. Saves $50 to $150 a month. Set a simple rule like eating out max 2x per week or only weekends. 3. Cash only or card limit for fun spending. Decide a weekly fun money number, say $60 to $80 a week, and stick to it. 4. Round down method. After each paycheck, round your checking account down to the nearest $50 or $100 and move the excess to emergency savings. Even just $75 to $100 a month cut from non-essentials makes that $250 a month contribution much easier. Your action plan for this week. If you want this to be very clear, here's what to do in the next 7 days. 1. Pick your Phase 1 target. Use $1,500 as your first emergency fund milestone. 2. Open or label a savings account. Name it Emergency Fund. 3. Set an automatic transfer. Amount $250 per month, or adjust to what feels realistic, $150 to $250. Timing, the day after your paycheck hits. 4. Do a 15-minute subscription plus bill review. Aim to cut at least $25 to $50 per month to support your savings. Conclusion. This plan gives you a clear, step-by-step way to start an emergency fund without overwhelming yourself. You set a realistic first target, $1,500, about 1 month of essential expenses. Commit to a manageable monthly amount, around $250 or $150 to $200 if needed, and make it automatic by using a separate emergency fund account with scheduled transfers each payday. For support, you track just your key bills for a month to refine your numbers and free up cash by trimming a few non-essential expenses like subscriptions and eating out. In short, you're turning saving into a simple habit. Set a clear goal, automate your contributions, make small lifestyle adjustments, and build momentum from Phase 1 to larger cushions, so you have real financial protection when unexpected expenses come up. Debt Free Made Simple has a program that automatically does all the budgeting for you, while eliminating all current and future debts and putting your money back into your pocket to build true wealth. If you're watching our podcast, please like, share, and don't forget to leave a comment about what you'd like us to cover next. I'm Lisa. Subscribe and see you soon. You've got this.
We can eliminate all your debt. Now you know. The rest is up to you. What are you waiting for?